This video should be following the YouTube videos on the income statement and takes the place of meeting in class after that in the second half of our last class after the exam. We're going to start this class with a little self-test. For each item shown on this slide, determine whether or not it should be included in operating income. The first item we have here is dividend revenue. Should that be included as part of operating income or not on the income statement? If you want to, pause the video here so that you can come up with your own answer before I review the answer on the next slide. Dividend revenue is not included on income from operations because unless the company is a financial institution, and let's assume in all of these examples that we're talking about a merchandise or a manufacturer or service company other than a financial institution or any sort of landlord or property management group. So we're not talking about banks and we're not talking about landlords, any other type of company. Dividend revenue would not be a part of a company's main operations. Next, we have sales discounts. Should that or should it not be included as part of operating income? Pause here if you need to think about it. Yes, sales discounts are a part of net sales, which is a part of operating income. Remember, sales, that first line on the income statement, is typically shown after all discounts, returns, and allowances. Sales affects gross profit, and then gross profit is a component of operating income. The next item is write-off of goodwill. If you're not familiar with what this means, write-off of goodwill, you need to go back to the YouTube videos where I work through each and every one of these items that we might see on an income statement. A write-off of goodwill is not included in operating income. What it means is taking down the value of an intangible asset that we're holding, the specific intangible asset goodwill that we carry on our balance sheet, saying it's not worth what we are reporting it to be, so we need to record an entry to take the value down. That is considered an unusual and infrequent item. Next up, we have officers' salaries. Pause here if you want to take a moment to think about it. Otherwise, we'll continue with the answer. Yes, officers' salaries, the cost of our senior executives working for the company, and therefore the cost of salaries and wages expense for them, that is part of running the company, so it is part of operating income. Next, we have loss on sale of equity investments. Would this be a part of operating income? Pause here if you need to. The answer is no. As long as we're not talking about a financial institution, the loss, or if this had said a gain on the sale of equity investments, equity investments means companies' stock investments. When a company owns stocks in other companies, that would be considered an investing loss, or if it had been a gain, an investing gain, as opposed to an operating. It's not related to the company's main focus of business. The next item we have is interest income. Pause here if you want to take a moment to think about whether or not this should be included in operating income. Interest income is not. This would be in the line called other revenues and income. As long as we're not talking about a financial institution, some sort of a bank, let's say Target or Walmart has interest income, that means it has bonds or some other debt asset, which is generating interest for that company. Walmart's main operations is not to generate interest by holding on to investing in debt assets. So interest income would be a non-operating item. How about restructuring charges? Pause here if you want to think for a moment. If you don't know what restructuring charges are, go back to that YouTube video where I walk through every type of item that we might see above income before taxes on an income statement. Okay, the answer is no. This is typically considered an unusual and infrequent item. Next item up is bad debts expense. Again, pause here if you want to take a moment to think about it. Bad debts expense is an operating item. It's the cost of selling to our customers on credit and knowing that some of those credit sales are never going to be collected in cash. It is a necessary part of running our operations, assuming that we do choose to allow our customers to sell on credit. Now, this was shown in my other sections where we didn't have to, we had an exam separate from the next class day. So I ran this as a Kahoot with a few more additional accounts where the grand prize was actually $1,000 to the winner of the Kahoot in each section. So I apologize that this is simply done in a PowerPoint format, but remember, it is the learning and not the money that we're most interested in this course. And again, if you had any trouble with any of these items, remember this is one slide from the video, and a big portion of the video set focuses on defining what each of these items are that are included in unusual and frequent gains and losses that we might see in the non-operating section of the income statement. Go back and review that video if you need to.